Let's get things going. So, as you are all aware, markets love certainty. But lately, they've been getting something very different. I mean, just within the last few days, prices were surging, geopolitical tensions was escalating, and investors were rushing into safe haven assets. Today, however, the tone is shifting. Energy prices are pulling back, the dollar is adjusting to changing risk sentiment, and markets from cryptocurrencies to equities are trying to figure out whether the storm is passing or simply pausing. If we have a look at the markets at the moment, USD JPY is navigating a complicated macro backdrop. Ethereum is doing the best to remain above $2,000, which is its current psychological level. And the Dow is balancing optimism against lingering inflation concerns. So, in other words, markets are still very much on edge right now. For those of you who are new here and don't know me, good morning. My name is Francois. I'm your market analyst here at ATFX Africa, and welcome to your daily market brief. Today, I'm going to be breaking down 3 specific instruments, but if there's any additional instruments that you want me to look at, please pop them through to me. I will be happy to do so. Just pop a message in either the chat section or the Q&A section, and I'll take it from there. So today, I'll be breaking down USD JPY, Ethereum, and the Dow Jones. These are 3 markets that are currently reacting to the same macro drivers, which are energy prices, geopolitical developments, and global risk sentiment. So, with that being said, let's begin today with currency markets, as always. So, USD JPY is currently being driven by a combination of safe haven flows, energy prices, and central bank expectations. Earlier, markets or marked volatility pushed by oil prices, where we saw moves sharply higher, and this was mainly due to strength within the US dollar as investors sought safety. But the narrative now is shifting quite rapidly. Recent reports suggest that the conflict in the Middle East may remain contained, which has caused oil prices to retreat and reduce some of the safe haven demand for the dollar specifically. Now, energy markets are also playing a really important role here at the moment. Japan is a major importer of energy. So when oil prices rise sharply or fall sharply, it can either worsen or benefit the country's trade balance, and this can severely weaken or strengthen the yen. But as we are now seeing energy prices ease, I mean, yesterday at one point we were heading towards $120 a barrel. This morning we're trading somewhere in the range of $80 to $85 a barrel. So there's definitely been a dramatic shift within the energy market as well. So as energy prices are easing, this pressure is beginning to fade. There's also a very important monetary policy angle because of the fact that recent data has showed Japan's fourth quarter GDP growth revised upward to 0.3%, which was supported by a strong domestic demand. Now, that being said, we also have real wages in Japan that rose for the first time in 13 months, which again strengthened the Bank of Japan's cause for gradually normalizing monetary policy. So in essence here, the USD JPY story right now is a combination of shifting geopolitical sentiment, energy price dynamics, and diverging central bank policy. Now, with that being said, before we look at the charts today, I want to cover something very important. Now, the only reason why I'm bringing the following up is because of a post that I saw today on LinkedIn, and I actually commented on the post as well. And the primary thing here about this post was, so the person stated that USD JPY is going to have a massive sell next week. And again, I'm not saying there's not going to be a massive sell next week. It's definitely a possibility. The part that bothered me is the reasoning behind it. And I want everyone, if you are watching my market brief or if you've attended any one of my sessions, you'll know that I'm a very factual person. However, regardless of what I even say, I want you guys to be confident enough to fact check because I'm confident enough in what I said. And for instance, this person stated that USD JPY is going to fall. Why? Because as you all are aware, government bonds, there's a total amount of government bonds globally or available, which is to the value of $30 trillion. Now, this is in essence the US debt, because why they sell these bonds to as guarantee that they will pay their debt back. And then the person stated that Japan owns 8 million of these government bonds, meaning that they in essence own around 35%. They are 30 to 35% of the total debt that the US has. So in other words, if they offload a trillion or 600 billion or whatever of this debt, this would obviously significantly have a lot of monetary inflow into Japan, and this would significantly affect the dollar's value. However, from a factual point of view, let me assist. Globally, if you take all the countries combined, only own I think it's $8.2 trillion worth of bonds. Not one country, all of the countries own $8.2 trillion of government debt for the US. Japan, however, is the largest holder of debt for the US, but it's around 1.2 trillion. Not even close to 8 trillion. It's 1.2 trillion. So that's the first part. The second part is Japan can't just go and sell $600 billion worth of bonds in 1 week. The bond market, yes, it's one of the most liquid markets in the world, but there's a certain cap to the trading per day. This offloading process would take place over a couple of weeks, months. Can't just happen like that. There's no just selling of $600 billion worth of bonds. It's physically not possible for a few reasons. First, obviously wanting people to buy it. And secondly, it would be detrimental to themselves because offloading that amount of bonds would also affect the rest of their holdings because the price of the bond market would drop significantly. So the value of the remaining asset would also drop significantly. So what I'm trying to get to is when you guys read things online or even hear me saying something that sounds a little bit out there, do the effort to just fact check. I mean, for instance, with the bond market, these are public records. You can just do a simple Google search and the bond registry will come up and you will be able to see who holds the largest amounts of bonds and what that value of the bonds are. Don't just randomly make trade decisions based on propaganda that you see online and you're like, oh, shucks, USD JPY is going to crash next week because of this. No. Okay. I hope that's making sense. I hope that's adding a relative amount of value to your trading and just the way you look at the market. Okay. With that being said, let's quickly have a look at the charts. So as you can see at the moment, USD JPY remains in an upward bias structure from a technical perspective. Having recently approached that 159 level, which is around that 123.6 Fibonacci extension level, which represents one of the highest levels seen this year. Now, some key levels to monitor here is definitely the support around 157.5, which is more or less where we are trading at the moment. And this is where recent pullbacks have attracted either a relative amount of buyers or sellers, as you can see from the price action surrounding the specific level. Resistance obviously is sitting here at that 123.6% Fibonacci extension, which is around about that 159 level. And this is obviously a level that has previously capped multiple rallies. You can see here, if you even backdated to earlier in January and so forth, it has seriously capped some upside momentum and some rallies with the specific pair. However, momentum indicators do suggest that the pair remains in a broader bullish trend, although short-term consolidation may continue if geopolitical tension stabilizes. Now, if we drop this down to a lower time frame, you can see here that we are currently trading within this lower time frame descending channel. Now, before entering into any specific trade, I would just wait for a break to either side of that channel. So either a break upwards. So if we get a break above this, let's call it 158, that could potentially lead to a retest back to that high point there around 159. However, if we break out below, and based on current projection, if we break out of this channel, that will also break below this level here, which is our 50% fib level. So if that level breaks, that can definitely potentially see a push, maybe all the way down to this 155.6 level. So again, just monitoring this on a relatively lower time frame. And the only reason why I do that is so you can get more accurate entries. Sorry, that wasn't the 50% fib level. That was the 88% fib level. That was the green line. And then obviously just selling down to various other um, support levels, which was indicated by our fib levels. I hope that makes sense. If you have any questions regarding this analysis specifically, please feel free to pop it for me into the chat section or comment section, and I'll be glad to have a look at it. I do see I have a request here for cryptos, not a problem. Definitely even having, definitely wanted to talk about cryptos as well. So I'm going to kick things off with Ethereum. And then after discussing that, we can go into having a look at both the Ethereum and the Bitcoin chart. So Ethereum specifically is currently operating in a challenging macro environment. But when we look at the chart, you're also going to see that Ethereum has been one of the most fun day trading cryptocurrencies as of late. And I'm sure Robert will agree with me on this as well, because I know he loves trading Ethereum as well. So the cryptocurrency recently climbed back above that 2000 level, recovering from a weekend decline. However, the broader trend obviously here still remains fragile. Crypto assets in general tend to be particularly sensitive to global risk sentiment. So when geopolitical tension rises or interest rate expectations shifts higher, investors often reduce exposure to higher risk assets. And cryptocurrencies tend to fall into that category. That dynamic that has been visible this year, if we can put it in such a way. Now, Ethereum has lost more than 30% since the start of 2026, highlighting just how sensitive digital assets remain to the broader macro conditions. However, short-term rebounds can still occur. I mean, if we have a look at recent price action, it suggests that short-term position liquidations helped push crypto prices higher earlier this month, triggering a temporary recovery. In other words, Ethereum is currently sitting at an intersection of global risk appetite, macro liquidity, and investor position. So when we have a little bit of a look at the charts here today, just want to switch over to Ethereum. Here we go. We can see that this has been extremely range bound since beginning of Feb, which again has created a tremendous amount of good day trading opportunities on this crypto. Key support is obviously still sitting there at that 1800 level, which is a critical psychological support at this specific point in state. And then we have our resistance, which is up around this 2200 level here at the top, which is where we've seen every single rally attempt so far for the last month and a half has stalled at that specific point. Now, when we look at our momentum indicators here as well, it does suggest that Ethereum is currently range bound with a relative amount of bullish momentum at the moment, and showcasing that traders are waiting for a broader shift in global sentiment before committing to a stronger directional move. Now, if we have a look at this on a lower time frame, we can see here this is definitely broken higher. And even where we are sitting now, here we can see we had this equal high was broken, change of character, and now it's coming back for that little bit of a retest. So even you've got two options here at the moment. If you wanted to, you could wait for the retest here on this EMA. So retest there on the EMA, maybe having a stop just below that smaller support level. And just on a day trade, that almost opens up a 1, 2, 3 risk to reward ratio just on that specific setup there. However, should you be a little bit more risk averse, you have the opportunity to maybe move your entry a little bit higher. That obviously significantly changes the risk to reward dynamic. You'll have to even push a little bit higher with your potential profit to get at least a 1 to 2 on this trade. However, based on this retest, if it pushes higher and breaks above that 2070, 2071 level, that would be the break of structure. That would indicate a move higher. So definitely the safer option, but little bit less lucrative. Down here, we have a little bit more risky option, but a more lucrative option. The only problem with this one is it does have the potential to just, push down, break lower, and change direction. So just obviously have your risk management in place and have everything set up on your side to protect your own capital based on the risk that you are willing to take on that trade. I hope that makes sense. If it does, let me know. If you've got any additional input, please feel free to let me know as well. Then, based on the request, switching over to Bitcoin, very, very similar to Ethereum at the moment, trading very much range bound right now. And that chart pattern has currently been disproved. So here we can see as well, starting to show some bullish momentum, still trading between that range, which is sitting here roughly around that 80,000 as a top resistance, and the bottom support sitting here around 60,000. So again, still trading within that range, but showing some nice bullish momentum with very, very similar setup, showcasing here the opportunity for a bit of a rally. On this one, you can see here as well, it's broken above all the EMAs. So there's a fair chance that we could aim at least for this beginning of March high, just on a day trading perspective at the moment, which is sitting at that round 74 level. So if we do break this lower, you can see here as well. So if we have a nice little break here, you can look at a potential option here, stop below that support, and then, well, just up to that level would give you around a 1 to 1.2 risk to reward ratio. Or you can push all the way closer to that higher resistance, which will then give you the 1 to 2 risk to reward ratio on this one. But definitely pushing up quite nicely even now on the lower time frame. Please let me know, especially everyone who's requested this. This was from Mohal. Just let me know if I hope I pronounced that correctly, by the way. Does this line up with what you are seeing? Are you seeing something different? Let's talk about it. Robert says, can definitely agree with the USD JPY analysis. I agree, yes, but was very focused on gold lately. That's fair. I'm guessing that was to my comments on Ethereum. Completely agree with Ethereum. Okay, fantastic. Just let me know about Bitcoin as well. Just want to see here that I miss any comments. Doesn't look like it. Okay, cool. I'll see if anything else comes through. If there's anything else you guys also want me to look at, please just let me know and I'll take it from there. That being said, let's move over into equities. And for today, we are discussing the Dow Jones Industrial Average, also known as US 30. So the Dow is reacting to all the same evolving macro environment that everything else is that we have discussed up until this point. So global equity markets initially came under pressure when oil surged and geopolitical tension intensified. But sentiment improved slightly after reports suggested that the conflict may not expand further, which helped ease pressure on the market. That improvement in risk sentiment has allowed equities to stabilize. We have seen the Dow Jones gain around 206 points yesterday, closing roughly 0.4% higher during our previous session. This gain was obviously led by companies such as Caterpillar, that was up more than 3%. Nvidia was up roughly more than 2%, and Amgen also advanced more than 2%. However, not all stocks participated in the rally. We saw companies such as Cisco Systems, Boeing, IBM were among the session's biggest losers. So that broader theme for the Dow right now revolves around two key macro forces. Number one, energy prices and inflation risk. And number two, higher oil price increases corporate costs and could delay interest rate cuts. Additionally, geopolitical risk is also adding another factor because of the fact that when geopolitical tension rises, investors often shift towards safer assets and away from equities. Now, the Dow typically performs slightly better than technology heavy indices like the NASDAQ during volatile periods because of its exposure to industrial and defense companies. So, when we switch over and have a look at the charts, we can see here that the Dow is currently trading around that 47,900 level, reflecting a recovery phase from the recent volatility. Now, support is sitting here at this lower level here around 47,000, where recent declines stabilized and then reversed. Resistance, however, is currently where we are trading right now, which is that 48,900 level, which is also the 38% Fibonacci retracement level, which does represent the upper boundary of the current trading range. And then our momentum indicators at the moment suggest that the index remains neutral to slightly cautious, with traders waiting for more clarity on macro conditions. Now, switching down to a lower time frame, you can see here this is almost forming a relative double top. Before entering into any buys, especially on a lower time frame, I'll wait for a break of this high here at 48,100. If that's obviously broken, you can aim higher to this 50 fib or even the 61% fib, which is sitting there at 48,900. For any sell opportunities, I'll definitely wait for a break below 47,000 and then potentially aim for this 45,800 level down here. That's just currently what I see from a price action perspective with regards to where we are sitting right now. Now, obviously, going into today's trading session, the three major catalysts haven't changed much since yesterday, but the primary ones that could influence market direction today, again, developments in the Middle East. Any updates regarding conflict could quickly impact oil prices, currencies, and global risk sentiment. Then, energy market volatility. Oil remains one of the most important macro indicators, so it's still influencing everything, even cryptocurrencies, all simultaneously. And then lastly, interest rate expectations. Any changes in expectations around Federal Reserve policy could severely influence the US dollar, which in return then influences broader risk assets. Traders, if there's any additional questions that you would like to ask me, please feel free. Just want to see here. It is the same setup, and my short-term trade just hit TP and looking forward to better trade to come. Fantastic. So I'm guessing that refers to Bitcoin. I love it. So that obviously just shows that what we are looking at the moment is aligning with what you are seeing at the moment as well. And by the way, congratulations on your trade hitting take profit. So super happy for you on that. So as we are ending off the session, I always like ending it with a question. And I think the biggest question we need to answer today is whether the recent easing in energy prices that we are seeing today is the beginning of stability or just a temporary pause before the next wave of volatility. Because as you have seen, if oil markets move, the ripple effects could spread quickly across all asset classes. And that means that you may want to keep a very close eye on the next set of geopolitical headlines. And traders, with that, we wrap up your daily market brief brought to you by ATFX Africa, the broker that gives you an edge in today's markets. Simply head over to atfx.com and, well, go and experience the difference for yourself. Traders, until next time, stay sharp, stay focused, and trade smart.